Trading businesses buy and sell stock. That's what makes them a trading business. So stock is a key asset. It's the sale of the stock that's going to generate the cash inflow, and it's going to generate the sales, hence profits. And the indicator, the KPI, which is measuring how efficiently the business manages its stock, is the stock turnover, the STO. This measures the average time for stock to be sold in days. And most businesses will look for less days. Less days means a quicker stock turnover. Have a look at this diagram in yellow. We're talking about the purchase of the stock, we wait, and then we sell the stock. So the goal is to reduce the number of days between these two arrows, the purchase of the stock and the time the stock is sold. Most businesses want to reduce the time between those points, that is, have a more rapid stock turnover, less days. Stock turnover is classified as an efficiency indicator, that is how well the business manages its vital asset stock, but it is equally a liquidity indicator, because not until the stock is sold can the business receive the cash, and it's usually via debtors. So even though it's classified as an efficiency indicator, it is equally a liquidity indicator. Look at this chart on the right. It shows a favourable trend in the stock turnover, decreasing days, less days. The stock is turning over more rapidly, and this would indicate a more efficient management of stock, and it would also be consistent with a more positive business liquidity situation. The stock is turning into sales more rapidly. If it's cash sales, that is instant cash as soon as the stock is sold, and of course sometimes via debtors. The key benchmark when evaluating stock turnover would be past performances, that is the trend. Look at the trend. Is the trend reducing in days or increasing in days? Businesses want the trend to reduce in days over time. That would indicate more efficient management of stock, and that would be consistent with an improving liquidity situation. It's also worth noting that the type of stock will impact on the stock turnover. Look at these two examples. A business that sells expensive jewellery and say a milk bar selling milk. The stock turnover for the business selling the expensive jewellery would be much less than the milk bar selling the milk because of the nature of the stock. So the type of stock will impact on the stock turnover. And that's why it's very unwise to compare the stock turnover of different businesses, that is businesses in different industries. It's best to look at the stock turnover over time in the same business. The trend is the most important, and most businesses would look for a more rapid stock turnover over time, that is less days, as a favourable trend. What are some of the problems with a slow stock turnover? That is, we're taking more days on average to sell the stock. Two issues. One is liquidity, that is the business's ability to meet its short-term cash commitments in a timely manner. In a business, cash commitments such as wages, rent, creditor payments, which is usually the biggest cash outflow, drawings, etc. These cash commitments are ongoing whilst waiting for the cash inflow from the sale of stock, which is sometimes, of course, via debtors. The business may have to run down its own cash reserves, reduce its bank account, and or go into overdraft to meet the ongoing cash commitments whilst they're waiting for the cash inflow from the sales. Ideally, of course, the business would want the cash inflow from debtors before paying its own creditors, but of course that ideal situation may not occur. So a faster stock turnover will be better for liquidity, because that'll mean there's a quicker cash sales, or quicker sales, then debtors, then the cash inflow from the debtors. So the major problem associated with a slow stock turnover is that it may be consistent with poor liquidity position.